From our Stars and Dogs segment, it's time for this week's Dog. Our dog this week is a venerable old name in Canadian retail. It's Sears Canada Inc, SCC on the TSX. Now, the stock lost 36.4% on the week after it reported on Tuesday that its first quarter sales were down 90 million or 15% to 505 million. More importantly, though, the company stated that there is now, and I quote, significant doubt as to the company's ability to continue as a going concern. Sears is now looking at strategic alternatives, including future asset sales or a sale of the business itself. That is not a confidence-inspiring statement. This is not really a surprise to Keystone. We actually selected Sears Holdings Corporation on the NASDAQ in the US as a dog this past fall. For its part, that stock, which was down significantly at the time, has already been cut in half once again since the fall. So Sears Canada now, for its part, is in a bad place. The company has posted reoccurring operating losses and negative cash flows from operating activities in the last 5 fiscal years, with net losses beginning in 2014. The retailer's net loss more than doubled year over year in the first quarter, and it abruptly pulled the plug on its annual meeting, which was scheduled for Wednesday this week, postponing it to an undetermined future date. Again, not the confidence-inspiring moves that you'd like to see. Now, generally, department stores, many of which have not recovered from the inclusion of big box specialty stores into the incursion of big box specialty stores into their core categories since the mid-90s, have particularly been hard hit by online retail, even as they try to grow their own e-commerce operations. We think that the company, Sears Canada, is in a bit of a death spiral. It has gotten so bad that people are now likely to think twice about purchasing items under Sears brand names such as Kenmore, as they will have potentially warranty concerns. This will likely lead to further sales declines in a very tough retailer market. So what is next for Sears Canada now? Well, retailers in deep distress or financial distress can seek protection from creditors under the company's Creditors Arrangement Act, or the CCAA, while they restructure. Sometimes after this, the result is a complete closure, as is the case with Target, which we saw it liquidated its inventory and shut down 133 stores less than 2 years after expanding into Canada. In other cases, it can leave the company leaner and more competitive, albeit with a smaller number of stores. Now, Sears has been down this road already, not the actually seeking creditor protection, but trying to right-size itself over time. It hasn't seemed to help. So as for investors that hold the shares or shares in Sears at present or are looking to hold shares, the news does not look good. Despite the losses in the share price and its an old venerable name, we would not touch the stock. It's in a very tough market. It hasn't adapted well, and we continue to see it as a dog going forward.